Here's something I've seen happen more times than I can count. A business owner's company is growing fast. Their net worth is climbing, maybe 20 million, maybe 30, possibly more. And they haven't thought once about estate taxes. One day they sit down and realize, if they died today, the IRS could take 40% of everything above the federal exemption. For some business owners, that's a massive amount of money their family wouldn't receive. The good news? We can actually eliminate estate taxes entirely if we get ahead of the problem. I'm Matt Lozano with Cinder Wealth. Let's start with the basics. The federal estate tax applies to the total value of everything you own that's inside your estate when you die. Typically, that's your business, your home, your investments, and your retirement accounts. Possibly life insurance if it's not structured correctly. Right now, in 2026, the federal exemption is $15 million per person, highest it's ever been. But that means if your estate is below that threshold, your heirs owe nothing in federal taxes. Above that threshold, the federal rate is 40%. Now, here's the thing. A lot of business owners look at that number and think, I'm not there yet. Maybe your business is worth 5 million or 10 million right now, but businesses grow, especially successful ones. One of the first things I do when I sit down with a business owner whose net worth is growing rapidly is project it out. Where are you today? How fast are you growing? How quickly will you hit that threshold? And here's the thing. That exemption isn't permanent. Congress can and has changed it. If the exemption gets cut in half, a lot of business owners who thought they were safe suddenly have a real problem. All right, let's talk about what you can actually do about it though. One of the most powerful strategies we use, I call a squeeze and freeze. Here's how it works in plain English. Step 1, you squeeze. You reduce or squeeze down the taxable value of your business. This can be done through legitimate valuation discounts, because a minority interest in a business or a non-controlling interest is worth less than a controlling interest. So we can reduce the value for gift and estate tax purposes. Step 2, you freeze it. You freeze that reduced value by transferring ownership from your estate or portion of it into an irrevocable trust. The value is locked in at the discounted amount and utilizes the current federal estate tax exemption limits. Step 3, watch it grow outside your estate. Now here's the powerful part. When the business continues to grow after the transfer, all that growth happens inside the trust, which is now outside of your taxable estate. So if the business is worth $25 million when you transfer it, and it's worth $200 million when you sell it, that $175 million in growth happened outside your estate. You're still going to pay income or capital gains taxes on it. You could potentially pay $0 in estate taxes on it. Now, to be clear, this strategy has to be set up properly. You need the right type of trust, the right attorney, the right valuation, and you need time. 3 years at a minimum before you plan to sell or exit. If we do this 6 months before the sale, we break the IRS look-back timelines and it doesn't work. Now, let me spend a minute on irrevocable trusts, because there's a lot of confusion around them. A revocable trust, like a revocable living trust, is one you can change or take back. It's a great basic estate planning tool that protects your heirs, keeps your assets out of probate, and passes assets privately. But it doesn't protect assets from estate taxes because you still control it. An irrevocable trust is different. Once you put assets in, you give up direct control. That's what makes it powerful for estate planning. Assets in an irrevocable trust are generally outside your taxable estate. But here's what most people don't realize. Irrevocable doesn't mean unusable. If it's designed properly, the trust can still create liquidity for you, such as through arm's length loans without pulling assets back into your estate. I've worked with clients above the $20 million net worth range whose attorneys told them they just needed a basic will. These clients had 10 to 15 rental properties, multiple businesses, etc. Projecting future valuations help us determine if we're going to move it outside the estate or hold onto it for a step up in basis. A basic will doesn't protect you from estate taxes. It doesn't freeze the business value. It doesn't coordinate with your financial plan. At a minimum, they need a revocable trust. At a certain level of wealth, you've outgrown basic estate planning. And most people don't realize it until they get a projection showing what their family would actually owe. Beyond the squeeze and freeze and irrevocable trusts, here are a few other strategies worth knowing about, each of which would need to be discussed with your advisors. Spousal Lifetime Access Trusts, or SLATs. These allow you to gift assets to a trust for your spouse's benefit, removing them from your estate while your spouse can still access them. A family limited partnership. Similar to the squeeze and freeze, these allow you to transfer business interests to a family member at a discount, reducing the taxable value. Charitable trusts. So if you're philanthropically inclined, strategies like charitable remainder trusts can reduce estate taxes while supporting causes you care about. Annual gifting. You and your spouse can each gift up to a certain amount every year to each person without using your lifetime exemptions. Small amounts add up significantly over time. The common thread? All of these work better with time. The earlier you start, the more runway you have to let these strategies do their job. So, here's what I want you to take away from this. Estate taxes aren't just a concern for people with massive wealth. If you own a growing business, you could be heading toward a significant estate tax problem without even realizing it. The strategies to address it exist. They're well within the tax code, nothing questionable, but they need time to work. If you hadn't had a real estate planning conversation recently, especially one that includes your business value in the projections, that's worth doing sooner rather than later. Subscribe for more content on tax planning, exit strategies, and wealth coordination for business owners. Thanks for watching.